We saw markets last week under pressure for most of the week. Then we saw that bounce towards the end of the week with those Michigan sentiment numbers coming out. And the picture you continue to see is a mixed picture. On the one hand, you've got the US struggling to fire, and then you've got China firing. But now the danger is, if one or the other drops, how safe are we from a real deep correction here?
Absolutely. We do need to try and see some balance and to see both sort of nations, the US coming up and China, keeping things going. The big piece of data, and there's a lot of data that comes out, I think that's most important is the jobs data, and following on from that, the retail sales data. So retail sales are driven by consumers, and consumers can spend if they've got jobs. So those are the two numbers. Then you've got consumer sentiment and these kind of things as well, which is obviously good consumer sentiment equals spending. But if you don't have the jobs and the money to spend, it's going to come to a standstill at some point. So, and at this stage, what we've been seeing is the jobs data. If it wasn't for the census data that came out, or the census hiring that came out a while ago, it would have basically been flat. The retail spending was under pressure last week. So very, very hard to try and make a call out of one or two data points, but it certainly is starting to look a little bit more negative, and that's scaring the market.
Yeah, so when you look at the two engines, as I said, you've got China on the one hand still growing strongly, the numbers are still looking very good, but there are concerns there about perhaps the chance of asset bubbles really taking hold, and then you also have inflation perhaps beginning to rear its head, and then you have, on the US side, as you have just said, you've got those problems with mixed sentiment. Now, at the same time, we're seeing the problems in Europe deepen. So you're not getting an alternative to those two. What's the danger there of us running down the China engine and killing it or perhaps damaging it?
Yeah, well, and it's interesting because China's a different beast altogether, and they're trying to control their economy and sort of prick these bubbles before they get there and trying to learn from the past. But history's told us you can't control these things, and as much as one thinks one's learned from the past, bubbles do form, and trying to call it, especially in such an opaque environment as China. There's money being lent everywhere. I see there's talk of them trying to gain control on the regional banks that are lending out. But the question is, where's the money gone? What's it been invested in? Is it real projects? Obviously, there's a lot of great things going on in China, but how much reckless lending is there out there? How strong is that banking sector? So it's really, really tough to get a hold of that Chinese economic data.
So what about Europe? For how long do we discount it? Because really, from what we're seeing so far, Europe is unlikely to be growing for some time. I mean, how many years should we be counting out Europe for?
Tough to predict. What we prefer to do is to look at a lower level and to look at the businesses. What's really interesting is that GDP growth and stock market performance aren't correlated. So what one tends to want to do is to say, well, China, emerging markets, Brazil, Russia, India, these are the places where we have to invest. And Europe and Japan and America, well, they're dead because growth is slow, and that's often opposite. So you can often find really good stock market returns from these areas, because what people do is they pay too high a price for growth. So yes, the emerging markets may continue to grow, but if everyone's piled in there, asset prices, it often takes a long time to make your return back because asset prices are so inflated.
So what are we to do with our market? I mean, here we are sitting with the gold price at a record, and at the same time we're seeing numbers suggesting that we're not producing much of the stuff anyway. In fact, production is slowing. So what do? Do you buy into our market on the hope that we'll get things right, or really do we discount our local market and just stick with the international markets?
Yeah, on the whole, we prefer the international markets. I'm wearing my Bafana shirt, so maybe I'm being a bit unpatriotic, but no, from a valuation perspective, on the whole, we see a lot more value in international companies, generally global multinationals. So they've got exposure to arenas across the world, strong brands, pharmaceutical companies like Johnson & Johnson. Locally, you can get hold of some of them, so we really like British American Tobacco as well. So strong companies with strong pricing power, that will be able to continue to maintain their margins. We're obviously concerned about inflation as well. So what one tends to do is, instead of going for gold, we'd rather go for a company that has pricing power. So if inflation does rear its ugly head, our businesses will be able to pass those kind of costs on. And a business like British American Tobacco is strongly placed to continue raising their prices.